Do you want control over your time and financial future? Are you building wealth for retirement and a legacy for your family? Of course you are, or you wouldn't be here listening to Breakaway Wealth. My name is Kim Daly, and I'm a top performing franchise consultant. For a limited time, I am making my brand new Creating Wealth Through Franchise Ownership webinar available to you for free. Most people don't consider franchising as a wealth building vehicle, but if you give me 30 minutes, I will show you how you can mitigate the risks of starting a business, leveraging proven tools as the CEO who works on rather than in the business to build and scale wealth quickly. Register for my free webinar right now at thedailycoach.com. That's the DALY coach.com. See you there.
You're listening to Breakaway Wealth, the show designed to help you build wealth faster, think bigger, and break out of the herd. Now, here's your host, Jim Oliver.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, I have Karl Krauskopf. Is that right?
There you go. Yeah, you got it 95% there. Karl Krauskopf.
Krauskopf. You know what, Karl? I was sharing with Karl audience that I was at the airport at 4 a.m. this morning to send my granddaughter to Washington, D.C. And I always say, even if it's Jane Brown, I say, hey, Karl, say your name for me. And I didn't do that because I'm just a little bit off. But
that's all good.
Karl, thank you for getting me from 95% of the way to 100% of the way, which is a great segue, Karl. And tell everybody about yourself and what you're doing, and a little bit about your background.
Sure. So Karl Krauskopf, I live in Seattle, Washington, and right now I am hyper-focused on the multifamily sector in both Puget Sound here, as well as expanding down into the North Carolina markets, Greensboro, Burlington, and Raleigh and Charlotte, but still opportunistically buying and focused in the Puget Sound, Seattle region as well, where there's not a ton of competition. Why? Because, the whole landlord-tenant law, there are a ton of restrictions, turns off a lot of people. It is more difficult to operate, more difficult to manage. But for the folks that can actually execute well, it's incredibly successful because we're not overpaying and there's very little competition, which is great. Also, our tenant grade, who we're actually renting to, is some of the best in the country. My average credit score on my tenants, in my personal portfolio, ranges from 715 to 735, whereas the market itself is 706. 706 is the average credit score, while the average rent to rather income to rent ratio is 5.1. So we've got some incredibly high-paying, high credit score tenants. So I don't really need the eviction the eviction restrictions don't really matter to me because, well, my tenants pay and they don't want to get that ding on their credit score, so they keep paying on time and in place. And other than that, development, I also love the development space. Again, here in Seattle, affordability, as well as many other places in the country, continues to be an issue. Supply is an issue. We've got two bodies of water on both sides of us, plus a mountain range. So we've got a lot of geographical, or rather topographical challenges or restrictions around building and the amount of density that we can actually put in place. So supply continues to be an issue, which, we certainly do take advantage of building detached ADUs. So that's becoming more and more prevalent across the country right now, where you can build these 1,000 square foot, essentially backyard cottages. And what's really unique about the Seattle market is you can actually build those and separately parcel them off. So even though they're on your primary residence or on a single family zone property, in Seattle you can build these 1,000 square foot detached ADUs and then convert the property into a condominium and then sell off or finance separately the two properties. And it is, it's huge play in terms of the detached ADU because our build cost, our all-in cost, I should say, is about 350, maybe 400,000 on a difficult lot, but our resale values are going to be 650 at the bare minimum, 750, 800,000. I've seen these things go for $950,000, and you're still building them at about 400,000. So
Wow.
massive, yeah, massive margins on some of these projects.
And how long
But
does it take you to build one?
right now, I've got one going up in my primary residence backyard. We started in early April, and we should be expected to be done by mid to late July.
Wow,
So let's say
that's
4
fast.
months, 4 or 5 months max.
That is fast. That's
Yeah,
cool.
yeah,
Well, you said a lot in there. You know, one of the things I really like that you said is you didn't think about all the reasons that you don't want to do business in your area. You said it's kind of that acres of diamonds mentality is, hey, I love it because there's not a lot of competition because people think, oh, it's too difficult, so I won't do it. I mean, that's ideal. And I love the fact that, you know, what you have to do to go against the grain is you have to have confidence.
yep,
Well, if you have confidence in what you're doing, then you don't care if everybody else is going the other direction because you have confidence you're going in the right direction. And one of the things that I noticed on your website was your kind of your pillars, and I don't remember if they were pillars, but just kind of your philosophy on investing. And I thought that it was cool and unique. And there was a couple of words that you started with that I thought that's interesting that's the words that you're leading with. You want to share that with the audience?
sure. So I think impact investing. I'm not sure if that's what you're
Yeah.
referring to, but impact investing is how are we investing in our communities to improve not only the tenants' lives, the service providers, i.e., contractors, property managers, things of that nature, as well as obviously the investors, the ones that are putting in the capital to make these projects happen. Is how are we able to provide good quality, affordable housing to a market that truly that really needs it. Right, we're not going out right now. I'm not going out and doing a LIHTC or low income housing. We're still doing market rate rents, market rate properties. But my philosophy is going and finding these particular multifamily projects or dadu developments where we can build or buy and renovate at such an incredibly low cost basis that in order to make the business plan work, we don't need extravagant dollars. We don't need extravagant rent in order to make the business plan, in order to execute on the business plan. So that gives us a, triple win situation of the tenants are winning in that they can still rent good quality housing at what we try to aim at 10 to 12% below market rate rent. Service providers, obviously, we're still coming in, we're still bringing in, third party property managers. We're still, we're not vertically integrated at this point yet. So we're still out there utilizing third party services. So we're still employing those folks. And then obviously from the investor's perspective, we're still able to buy and exit a property with the intent of getting to that proverbial 2x equity multiple in that sub 5 year time frame.
No, that's very cool. You know, it's funny. I like what you said also in when you describe your investment strategy and your company strategy is obsession. You know, and you talk about loving what you do. So tell me, where did that come from? Tell me, like, you know, how'd you start off your career, and where did this obsession with real estate come from? Because
Sure.
you have this, and I don't really know where it's at, and I don't know how to ask the right question, Carl. But like, there's this kind of moral, I don't want to say moral obligation, but this, you want it to be a good deal. You want it to be a win-win. You're looking for it to be, hey, if I can get these at really good deals and I can still keep the rent under market and all. And I think that that's a unique approach that I don't hear every day. So I want to hear where that came from and touch more on that philosophy.
Sure. Unpacking the questions, I started off, I spent 10 years in corporate strategy and business development for a healthcare company prior to joining or prior to starting my company full time 2 years ago. So spent 10 years in corporate strategy, business development, and my focus, my goal, my responsibility was to aid in the growth of a services company from took them from 100 or excuse me about $80 million to $150 million in top line revenue over the course of about 3 to 5 years on the tail end. And my again, where all of this obsession, where all of this growth came from was really truly being in a position in the healthcare space in wanting to make customers, or rather consumers' lives, be able to afford services that they may not have necessarily been able to afford, whether it's through unique service offerings that we helped provider groups kind of create and instill and go out to the marketplace and offer, while also being able to take a product back over to the payer, the insurance company, and be able to be reimbursed or paid for in such a way that, again, the provider group was profitable. So this mentality of the last 5 years, the last 5 years of that tenure at the company was all about how do we make it, again, a triple win situation of the consumers are able to buy or pay for services or receive services that they may not have necessarily been able to receive because of their income levels, be able to create a program for the physician group or the provider group, whether it's again physician group or hospitals, be able to offer a plan, a program to the consumer base, so that way they could build up their referral network and they could still be um, paid well by the insurance company to create these programs and manage the members, manage the consumers. And then obviously at the top line, insurance companies, we all know that they are the ones making the cash hand over fist. So, it was again kind of creating that triple win situation, taking that into, there was a great deal of time on the front end of my investing career where I was just flipping and developing. But, I took that package, that program that I was doing with healthcare, and that fits really, really well into the multifamily space.
Yeah, no, that's very cool. I mean, kind of, I think you have a special skill in disarming, situations by balance. I don't know if that's the right way to say it. Like, I feel like you have the skill of being able to balance, like, hey, I know here's what you want, and this is what you wouldn't accept, but like, let's put you in the middle, this one in the middle, this in the middle. Everybody kind of is in the middle of where they would want to be, where they would hate to be, and let's make this thing work. And it's
Yep.
kind of, I like that strategy because there's an old book. It's called Strategy of the Dolphin, right? And it talks about being a corporate structure, and you can be the shark. And yeah, sometimes the shark gets to the top, right? Because and they say sharks only look up, right? So, but the dolphin, if you can do it like the dolphin, when you get there, nobody hates you, and
Yep.
and so, I mean, there's more to that book than that, but that's one of the messages that I took from it is you want to make it to where, you don't have to make enemies on your way to the top,
Right.
is what I'm trying to say. And you don't want to feel like, oh, hey, I bought this property that was worth 2 million for $1 million, and the lady didn't know what she was doing. I mean, like, it doesn't have to be like that.
Right.
That it doesn't have to be predatory. It can be a win-win for everybody. And I think that takes a special skill to kind of balance that. And if I were sitting there looking at investing my money, I like the fact, because those deals are going to be solid, right? You're never
Yep.
going to have a really bad deal typically, because you're really balancing it out and making it work. The other thing that I think happens is you get more sellers that are willing to get creative, because again, you build that trust. So I love some of the projects that you were talking about and some of the ways that you've structured it. North Carolina, it's funny because, that's I mean, it's so far from where you live, right? How did you choose North Carolina?
A couple of reasons. When I was back in my corporate job, in the healthcare space, a lot of our technology offerings were based out of Raleigh. My brother at the time lived in Raleigh. So my wife and I traveled to Raleigh, and I traveled there for work frequently. So I had a baseline of familiarity with it, but never really truly considered it as an investment standpoint until recently. And from a expansion standpoint, they've got some of the necessary fundamentals in place from a population growth. Charlotte has been absolutely on a tear from a population growth standpoint. Their cost to entry is relatively low, right? We're still talking in like the Burlington, Greensboro market where you're buying anywhere from mid 80,000, so let's call it $85,000, up to $150,000 for some solid Class B, even Class A properties in again Greensboro, Burlington, where your rent is, your rent is solid. Your rent is going to be at about that 1% of the purchase price on a per door basis. And, it's great. It's got some of the asset based fundamentals that make it a strong investment. And then it's got the strong market fundamentals that again make it a good long term place to be in.
I like that too. And I like North Carolina. I've done a few years ago, we did a bunch of stuff in Tennessee. And I think
Yep.
Tennessee is still a great market. A lot of people from California moving to Tennessee. But, one thing, this is totally off, it's not off subject, but talk about markets and knowing your market. Southwest Florida is growing really big, right? That's where I live. And 8 months ago, we had a hurricane and wiped out Fort Myers Beach, and our house was damaged. In fact, you can't hear it because I have a good microphone, but I got people going in and out my door, finishing up the house, and we got some tile, we got some garage floor stuff, and it's getting close. But here, the one big fear, and rents are going up. That's not an issue, but insurance. Getting that curveball of insurance.
Yep.
And when you look at the market, I think sometimes the coastal communities, they're really kind of, if I show somebody a house and I say, hey, that rents for 25 grand a week, well, you can get really excited about 25 grand a week. But hey, by the way, you got to self-insure because you're not getting insurance on that house. Oh, wait a minute. Time out. I got to put my whole life savings up for something like that, or a part of my life savings, and it could be blown away next hurricane season and I don't have insurance. Or if I do have insurance, it's so expensive that 25 grand doesn't look as good as it did, right?
Yep.
So talk about how you do research in the markets and how you know your market. You do consider, like just kind of your due diligence. Where did your process come from?
Sure. So I guess one thing that I want to make mention before jumping into that is, Seattle and the Washington State market, from a natural disaster standpoint, is relatively insulated, right? And that's one of the reasons our expense to gross income ratio is so low on the multifamily side, right? Feasibly on a Class C, Class B property, you can get in and get away with anywhere from 35 to 45% of your expense to gross income ratio. Whereas you look at, some of the other Sunbelt states, Phoenix, or not Phoenix, but parts of Arizona, Texas, Florida, your operating costs are going to be quite a bit higher. And one of the two big drivers of that are taxes and insurance. As you were alluding to there, one other reason why I really like the North Carolina market is they are also relatively insulated from those natural disasters that typically drive up insurance rates. From that perspective, again, North Carolina is a little bit more expensive from a expense to gross income ratio, but than Washington, but it's still far more favorable than some of the other Sunbelt states. From a due diligence standpoint, right, checking in markets, right, wanting to make sure that our population growth exceeds any of the the national average from a actual city basis, right? If I'm investing in the major city, Greensboro, for instance, or Seattle, for instance, it's pretty easy to designate which parts of the city make sense. And what I look for is go on to whether it's niche.com or some of the other city data, where you can get neighborhood specific analytics and understand population growth by neighborhood, crime rates by neighborhood, and type of job, type of employment by neighborhood is the ideal situation. So that way, what type of sector the employment is based off of, right? Think you want, high diversity, right? You don't want to just be tied to one specific industry. You want, or at least, I also want high paid employment types, right? That's pretty easy in the Seattle space because, we've got a whole ton of technology, aerospace, consulting, etc. So it's pretty easy to get those high income earners. Greensboro, Burlington, Raleigh, obviously going to be a little bit different. And so you're trying to figure out where those employees or where those tenants are commuting to, what city. And so you look for, apartments that are nearby or on those major thoroughfares where you can tell geographically speaking that they're commuters, right? You don't want somebody, you don't want to be, I don't want to be buying an apartment that's so far from a commuting thoroughfare that it's obvious that those tenants are going to be in market service supporters.
Right. No, that's cool. I always like to ask people kind of their process. A lot of people that listen to this show, Karl, they're doing infinite banking. They're looking for, what do I do with the money in my own bank? How do I invest it? A lot of people don't have time. They want to do it passively, but they want to do it with some philosophy that they have alignment with. And I would encourage people to check out your website. Give everybody your website again.
So it is aurorasinvestmentgroup.com. Auroras are the northern lights. So my daughter's middle name is also Aurora. So it's investing in something beautiful, right? Something beautiful, something rare.
All right. So Karl, if God came down from heaven and only allowed you to retain the knowledge that you've received from one book that you've read, what would that book be?
I would confidently say it's What It Takes by Steve Schwarzman.
Wow. Okay. I have not heard of that book. I love when there's a book that I haven't heard of. What It Takes. Tell me just a little bit about it.
So Steve Schwarzman, the CEO over at Blackstone, goes through his almost an autobiography style approach to his rise in the investment asset management space. Things as commodities to ending in real estate, and now being one of the leading asset managers in the world.
That's awesome. I definitely will check out that book because I'm always talking to people about what it takes and somebody to have that kind of success. And I love to hear the kind of the personal story behind somebody's success. And normally there's some adversity in there before the success. So right. I'm just guessing, but we'll see what that might be. Karl, thank you so much for your time. We'll put all your information in the show notes. If anybody has any information, I'll have Karl's contact information in there as well. And we're going to wrap this up with, like we always do, with the incredible words of Earl Nightingale. Take it away, Earl.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Once again, thank you so much for taking the time to hear what was shared on today's podcast. If you are looking to discover new wealth building strategies, then go to community.createtailwind.com. That's community.createtailwind.com to join our free online community and get access to free courses and in-depth training videos designed to help you build wealth and break away from the herd. Click the link in the show notes to access the community today. Thanks again for listening.